Good evening and welcome to Money Matters. I'm your host Brian KOHUTE from HJ Wealth Management. My co-host Paul Mitchell from First Cornerstone Bank. We have a special guest, Tom Dunkel from U.S. Mortgage Resolution. So it's going to be a great show. I'm glad you joined us. Good seeing you, Paul. How are you?
Great to be here, Brian.
First, I guess I know you do a lot of lending to businesses and real estate. So I guess what's going on in the real estate market?
Well, it's definitely picking up. Values are increasing. Still, there are a lot of pockets that haven't recovered from the old days, shall we say. But people are getting more confident, willing to make investments, and put up there's a lot of new construction, a lot of I think new residential and all. Still, a lot of the banks aren't funding new tract developments, 30 houses or 40 houses at a time. So that's it's coming a little bit at a time.
Okay, so yeah, I guess you hear two sides of the story. Hey, the banks aren't lending, and I mean, is the demand out there? People want loans, or
yes. The critical thing is the banks really are desperate to lend. They have a lot of cash, like so many corporations do these days. Cash to put to work, but it has to be the right situation. It has to be to companies that have a track record of profitability, a track record of being able to repay the loan, that type of thing. That have cash, equity to put into the deal, the skin at risk type of thing, et cetera, et cetera. But actually, it's getting to the point that banks are becoming actually competitive, and rates are not coming down a bit in terms of spreads and all. Banks are desperate to put money out, and they're very competitive, and will really sharpen their pencil for the right deal.
Yeah, that's cool. That's good to hear. And I guess if you go back to old shows, we've been saying for years rates are going to go up.
Yeah.
So I guess we can say it again, right? They're eventually going to go up, right? So
I certainly think so.
Right.
But like you said, we've been saying that for seems like a couple of years now, and the rates are still at historic lows compared to the last few decades or even 50 years.
Yeah. So do you have insight into the overall economy? How do you feel about the U.S. economy? I guess you see a lot of small businesses that seem to be doing pretty well and certainly survived the worst of the crisis.
Well, certainly those that survived, are a good breed. A good breed. They've learned a lot. They're tough. They bit the bullet. They crunch down. They're good managers now. Right. I think a lot of what you see in small business are niche oriented type businesses. For example. We have a customer that manufactures signs, custom-made signs, not something that you just print out or have made in China by the thousands or something like that. But if you're maybe a high-end store, you want a certain type of sign, a certain type of look. You want it done, all the colors and that kind of custom-made design. Right. Their business is doing quite well.
It's good to hear. So, do any of your customers international and all? You have a feeling how internationals do, and so from a valuation perspective, people are arguing there might be more opportunities internationally now since the U.S. has this great. And again, we always caution don't time this show since it's taped, but and obviously speak to your advisor before you make any decision. But do you have a sense of U.S. versus international, or an opinion at least?
Well, two things. One. Smaller businesses are doing more international business than ever before. It used to be you had to be like $100 or $1 billion company before you think about going international. But now, whether it's the internet or just other ways of doing business around the world, there's a lot more that small businesses with even a few $1 million in revenues get into. On the other hand, you talk about interest rates, or you talk about the strength of the dollar.
Right. Stronger
the dollar is, this is more expensive that an international customer is going to have to pay for the item compared to a year ago. So that's put a damper on it. You certainly see that with very large companies.
Yeah, great if you're traveling to Europe, right?
Yeah, but, I plan to in a few months. So
there you are.
Things remain stable.
Yeah, the dollar holds up. So do you see, I don't know your level, do you see, there's been a lot of foreign demand for U.S. real estate. Are you seeing that down at the level that you're dealing with, or not so much?
Not so much, occasionally. Occasionally. But certainly people overseas, I think it's a great barometer of the strength of the U.S. economy over the long haul. It's the safest place to put your money.
Right.
So I mean, you may be opportunities at home, and whether you're in India or China or France or Italy or something like that, but it's a safer bet to invest in the U.S.
Yeah,
so and there are different programs that are encouraging that, different communities and all.
I mean, I guess we have to talk about energy with what's happened to oil.
Absolutely.
And again, this show's tape, but oil had a 50% drop. It's coming back now, right? And so now everyone's saying, well, it's going down to 30, and the other camp's going, it's going up to 80. What do you think?
Well, I think it's just a terrific example of the commodity markets.
Right.
I mean, nobody has. You can be the sharpest businessman in the world, but if you're in the commodity business, you really don't control the prices there. So you have to have a strong stomach, really know what you're doing, and not be too dependent upon those swings.
Yep.
You really have to know what the kind of business you're in.
I mean, you're either a speculator or a hedger, right? And I mean, it's not really an invested. We talk about long-term investing. Commodities is not the place to do that, right?
No,
you're either speculating or hedging.
Nobody predicted that 50% drop.
Nope, they predicted the opposite, right? It's probably going up. So.
Right. Well, you're talking part of the energy business, of course, is the fracking thing.
Right.
So I don't know if you're tracking companies in that.
Yeah, it's interesting. Recently, one of the big hedge fund managers just trashed the fracking company. Said they're leveraged up, right? So talk about interest rates. They're leveraged up. They got some debt coming due, some high yield debt, and they're going to have a hard time paying that and refinancing. So he's pretty negative on it. And a lot of people came out and said, hey, at this price, they still make some money. I mean, there's definitely a glut, right? There's a glut, and quite honestly, I believe in supply and demand. Prices went down because we have a lot of supply, and demand slowed down a little bit. So there's no magic to the economics of that. So I try to get away from opinions of the future, because if I could guess that, I wouldn't be sitting here, right? So, you had an opinion on GE. You like GE, or?
Well, it's a huge company. It was one of the industrial leaders of this country for decades. Founded by Thomas Edison and all. Right. And it primarily a manufacturer, but a couple of decades ago got very heavily into the finance business.
Right. Yeah.
The story of it. It got into finance business because it would be selling whether it's refrigerators or turbines or something like that. And hey, why not finance them too, to encourage the sales of it? But they got into pure finance, all kinds of financing, really competed with banks.
Right.
Made a lot of money in it. Got hurt.
Got into trouble with it.
So, right. Yeah. So. But I think it's an example of one of the comments about why they're getting out of the financing business is because it's a regulated industry, and they are such a large company, even though they're not a bank per se, because they're such a big player in the financial industry in this country, that the government felt it appropriate to start regulating it.
Yeah, they tagged them as whatever the term they're using, significant, right? I mean, that's, I think, a lesson we all learned from the financial crisis is a lot of people had their hand in that pot, right? And when it went down, it went down fast, and companies you couldn't imagine were exposed. And you're like, how did they get exposed to that, right? So I mean, I think GE went down pretty low. So, so I guess what's your outlook for the future? You feel everyone's kind of been worried that we've been in this long-run bull market cycle, and it's got to kind of pause or give it up. You still feel pretty good about it?
There's certain aspects that are still kind of weak, whether it's the employment thing or the underemployed situation, and there are a lot of segments of the economy that are still hurting, despite the. If you just look at the stock market, you see things must be rosy all around, but they're not. Yeah,
I mean, one of the challenges, and we get this with our clients. Sure, you're hearing too, is like, well, where do you put money, right? Like bond yields are so bad. Cash doesn't pay a whole lot. Real estate is tricky, right? Which we'll learn. Our special guest will tell us how tricky it really can be, right? So stocks seems to be a natural place to put it, especially with this low interest rate. And I'm a stock guy, so I believe that long term. But everything's cyclical, right? So you have to be careful. Well,
but overall, I still feel very strongly about the U.S. economy. And again, compared to other economies around the world, whether it's in Europe or Japan, or even even China, you see some of the blue coming off that rose.
Yeah, I mean, if you're a long-term investor, no problems, right? It's the people that are speculating that are ones that are going to get in trouble, right? Trying to jump in and out. But if you have a diversified portfolio and you can hold it, the U.S. is a pretty smart place to be, for a large part of your money, right? For a large part of your money. So, do you have time for a question?
Sure.
So Ralph Thomas from Exton asked, are banks a good investment if interest rates go up?
Yeah, well, I'm a banker, so I should have a great answer for that. But I guess I'd have to say it kind of depends. But generally speaking, I'll give you an example. Let's say a bank has $100 million of capital. That is, it has no deposits, just capital. So It has it's not making loans or anything. It's just putting the money in the Federal Reserve overnight or something like that. As you said, the interest rates, the return on that are like 0.01%.
Yep.
It's like zero. Well, if interest rates were 6%, it'd make $600,000 or $6 million. Excuse me, $100 million, $6 million. So, to that respect, absolutely, banks would definitely would perform better with higher interest rates. But then it's a matter of how high.
Right.
If interest rates were 15 or 18% and it squeeze the economy, and who can afford to pay those rates? How can banks make loans and grow their portfolios that way? So I'd say the first answer is yes. If interest rates go up, banks will definitely do better.
Right.
In fact, there's a lot of what they've been complaining about the last few years, interest rates being so low that it's really hurt their performance.
And also, we probably have to caution investors have to be careful, right? Because not all, there's the super banks, like the large ones who may not even look like banks, right? And the regional ones that take money in, lend it out, much more traditional, right? So.
Well, it's a good point because a small bank with let's say $100 million of assets or something like that probably is not going to be a player or a significant player in the energy business.
Right.
The huge banks are. So the huge banks are going to be more dependent upon the performance of those energy companies, whether the oil price goes up or down.
Right,
whatever.
That's a good point.
Well, a smaller company probably, if energy prices are low, their cost of electricity or cost of running the fleet of buses or something like that is going to be less, so they're going to be do well. Whereas a large energy company, it's going to be selling their energy at a lower price, and they're going to be do poorly.
If you have a question, here's how you send your question into Money Matters.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Welcome back. Now it's time to introduce our special guest, Tom Dunkel from U.S. Mortgage Resolution. So Tom, I know you deal with distressed real estate. Tell us about your background, how you got into this, and a little bit about yourself.
Sure. Brian, Paul, thanks for having me. Basically, I stumbled into it by accident. Like a lot of other opportunities in life, I saw a need, and as an entrepreneur, I kind of went after it. So basically what happened was I was a corporate finance guy for a number of years. I was doing mergers and acquisitions for big companies, but wanted to do something on my own. And 2006, decided to get into real estate.
Great timing.
Yeah, how about that? Great timing. So learned some lessons there. I have the battle scars to prove it. But still was passionate about it, excited about real estate, and saw a way to make a business there if I could just grind it out. So started buying properties, still have some rentals today. I've done some rehabs of properties and sold them. And along the way I started hearing about investors buying distressed mortgages. And with my background in corporate finance and my interest in real estate, those two factors kind of came together and really made it sound interesting for me. So 2009 started buying distressed mortgages, and fast forward to today, we built a really nice business. We've been at it for a while now. We buy distressed mortgages all over the country, and it's an exciting time for us now because we're actually relaunching our property business, and we're going to be buying and rehabbing properties here in the Philadelphia region.
Oh, great. So who are you buying from? Banks or investors? Who's your your target?
On the mortgage side of the house, we buy from big banks, and those pools of mortgages are all over the country. Here locally, for the property side, we're buying from homeowners who. And some investors, but mostly it's homeowners who just had a challenging property, and for whatever reason, whether it's a health issue or a divorce issue or a money issue, they just can't handle the property anymore. And so we offer them an opportunity to get out of that property. and get rid of that worry and hassle.
Tell us about the competitive landscape. I assume you're probably not the only company doing this type of thing.
No, certainly not. We have plenty of competitors out there, especially here in the region. But you have to remember, it's a big market. So there's a lot of room for players out there to buy properties and rehabilitate them, and really, what we're excited about is changing these neighborhoods. When a house goes unkempt for a period of time, it brings down the property values. A lot of times those folks aren't paying their taxes and things like that. So when we're able to take that non-performing asset, if you will, to use a banking term,
Sure.
And turn it into a performing asset, it helps the community. And so there is competition out there, but there's plenty of deals to go around. And we're smart about it. We don't get caught up in bidding wars and overpay for something just because. But we're patient, and we can do the analysis and make a good deal.
If someone's struggling with their property, how do they find you? How would they get to somebody like you?
They can go to Google, of course. That's what everyone does now.
So they would put in distressed real estate, or what do you put in?
Oh, sure, yeah.
Okay.
If you put in, I want to sell my house quickly, you'll find all of our competitors there along with us.
Okay.
So you buy the property, you buy the mortgage. What do you do then? And what's the time frame?
Sure. So on the mortgage side of the equation, we buy these pools of mortgages, and typically that could be anywhere from 10, 20, up to thousands of mortgages. And a lot of times what we'll do there is we'll carve off some smaller pieces, and we'll sell those to investors that we work with and around the country. Maybe there's a guy that just likes California loans, so he doesn't want to buy that whole big pool. He just wants the California piece. So we'll carve that off and sell it to him, and that, of course, makes for a short hold time. On the other hand, there are properties or mortgages that we'll hold on to, and with those borrowers, we'll work on get a workout done. And because unfortunately, a lot of folks just got in over their heads, and we're able to really right-size their mortgage for their new financial reality. And so their payment may have been a couple $1,000s or whatever it was, and because we buy the loans at a discount, we're able to take much less of a monthly payment and still keep our investors happy.
What kind of returns do you target when you're looking at either a property or the actual mortgage?
Yeah, so on the property side, we're targeting a 20+ rate of return there, and that's pretty similar on the mortgage side as well.
Is the mortgage, do you ultimately wind up taking the property back, or for the most part you can work it out and have the borrower on a plan that they can afford, and
Great question. Our goal is to really do whatever the borrower wants to do. If they want to figure out a way to stay in the property because that's where their kids are growing up and they go to church around the corner and that's their neighborhood, we do whatever we can to make it work for them. So there are some instances where the property's just become too much and they just want to get rid of it, and so we'll take the property back, and then that situation we'll turn around and sell it.
What kind of investors do you have? Do you have mom and pops, or the average individual down the road? Do they use retirement funds, or what kind of funds would they use to invest in this type of thing?
So to this point, our investors have been mostly mom and pop and high net worth individuals. We started to tap into the small institutions now that we're starting to get some scale. But personally, I really like working with the smaller investors. It's like, as you guys were discussing earlier, it's tough to find yield out there. And so the funds that we have and the opportunities we present to investors gives them a way to earn cash flow at a nice yield secured by real estate. And so it really fits nicely into a person's retirement portfolio. And we have mom and pop investors that are using their self-directed IRAs to buy into our funds, our private placements, or even buy mortgages or properties.
What's a self-directed IRA?
So self-directed IRA is really an IRA that just has a lot more flexibility to it than a traditional IRA that might be at a Schwab or a Merrill Lynch. The IRS only tells investors what they can invest in their IRA, which are some esoteric things like coins and artwork and things like that. They don't tell you what you can't invest in. So we work with a number of IRA custodians that allow for their customers to self-direct. So they can buy physical gold, they can buy into private placements, they can buy real estate, they can buy Eagles tickets, they can buy whatever they think makes sense to have in their IRA to earn a return over the long term.
What do you think the impact of rising interest rates would have on distressed real estate?
That's a good question. And it's tough to say because I think there's a lot of uncertainty in the market. The interest rates, if they went up, I think that could have a negative effect and create more distressed properties out there. Because a lot of people, unfortunately, have these adjustable rate mortgages, and the number of those in the billions of dollars are going to be resetting over these next few years. And that could really put a pinch on some homeowners who right now might be getting by okay paying their mortgage. But if those interest rates go up, those folks could find themselves having a difficult time.
Where the opportunities that you've seen so far, has it mostly been in a fixed landscape? They just bit off more than they can chew from a monthly payment perspective, or?
Yeah, they all had some kind of life event that just tripped them up, whether it was a health issue or a family issue. Their income was cut for whatever reason. They all had some problem that put them in this situation. I mean, no one buys a house and takes out a mortgage.
So can't wait until I default.
Yeah, right. Expecting to not pay it back. Yeah. But unfortunately, life happens, and that's typically how we end up with these distress situations.
Well, they get distressed. Why don't they just call up the realtor and say, "Property's for sale. List it. Get the best price you can."
That's great question, and I think sometimes that is an option, but other times they owe too much on the property, and so for the realtor to sell it, they'd have to do what's called a short sale, which means that they're paying off less than what's owed on the loan, and that just causes all kinds of gears to grind to a halt in the banking system because it has to go through multiple layers of approval, and it can just be challenging. And what they say out in the market is a short sale makes for a long buy.
How do you guys use leverage? How are you financing your real estate and mortgages, I guess?
Yeah, on the mortgage side, to this point, we've strictly been an equity buyer. We raise pools of capital and buy the mortgage pools. On the property side, we're using leverage. It's typically what we'd like to do is use private lenders, which are folks that might have a self-directed IRA, and they wouldn't mind making a nice return on a first position mortgage in their IRA that might be a 6 or 12 month loan. So we do a lot of that, and for certain opportunities we'll look at either institutions or going to banks for more traditional financing.
Well, it's sort of reflecting back on Brian's question about the real estate market in general. It sounds like that it really hasn't recovered that much. That if there are a lot of mortgages are still underwater.
They're not as many, but there certainly are mortgages that are underwater. I was just reading about how there are bidding wars going on in San Francisco, but then here in Philadelphia, the prices are actually down a little bit. So real estate's very local. I try not to generalize too much because every deal is different, especially in our mortgage world. We're buying mortgages on properties in Texas and Michigan and Nevada, and there's every neighborhood is different. Just like here locally, if you're on this side of the street and you go to that school district, your house is going to be worth more than if you're on the other side of the street and there's a different school district. So
So what would you say to someone listening to this and I should go get into this. I go buy some distressed real estate or mortgages. What lessons would you warn them about at least? So.
Yeah, it's not without its challenges. It certainly is something that people have done successfully. I personally know people who have their regular job and they just buy a house and fix it,
flip it
2, 3, 4 times a year, and that's just their side business, and they can be very successful at that. To make it a business, though, where you're having to, pay people and insurance and things like that, it's a lot more challenging. But there's plenty of resources out there for people to learn. Every local area has its RIA, it's Real Estate Investment Association. So here in the Philadelphia area, it's DIG, Diversified Investors Group. And they have meetings every month, and they bring in speakers, and they have special courses, and so there's plenty of resources like that available. Speaking of the internet, there's a site called meetup.com, and you can find people to go rowing with or running,
hiking or whatever.
But there's also real estate investor groups in there, and they might be specific to commercial real estate, or they might be specific to landlording or what have you. So if someone takes a few minutes to look around, they can certainly find some resources to help them.
What's your view on the real estate market in general the next, let's say, 12 months?
I would really like to see it continue going up, because in general the market has been increasing. But there is some uncertainty out there. I guess the good news is when you own an asset that's secured by real property and it's throwing off cash flow, you can survive, you can do well in either scenario.
Let's talk about the millennials for maybe a minute, about a minute or two to go.
Okay.
Is that a segment that you recognize as a distinct unit in your marketplace?
I would love to tap into that market. In fact, some of the guys on my team are millennials, and they're interested in buying property and starting a rental portfolio. And I think they, in particular, they like the cities, and they also like to help improve the community. I think that's kind of the millennial mindset, and so we love to help them do that.
I mean, they're saying that they don't buy as quick, like they've been renting longer. I don't know if you see that ad or you just haven't had the experience with them yet. But
is that what they say? I haven't heard that, but for folks like that, maybe it's they have some cold feet because of the challenges that the real estate market went through a few years back.
Yeah. Well, we could talk for another hour, but unfortunately we ran out of time. So, Tom, we really appreciate it. Please join us next week for our next guest, Scott J. Cohen from Quattro Direct. He's an expert in direct marketing, and as always, your money matters. Thank you.